So as retail traders, we pretty much all have the same tools, right? So if you've been trading for a while, you know that no matter the strategy that you're using, we're pretty much using the same technical tools. Trend lines, support resistance, Fibonacci, moving average, other indicators might be RSI, MACD, Bollinger Bands, whatever the case may be, psychological levels, and so on and so forth, okay? And you might ask yourself, well, if every retail trader is using the same tools, what is the difference between a good trader, a profitable trader, someone who is progressing fast, who is making good return on their account, and a bad trader who is not profitable, losing money, not understanding what's going on, has difficulty creating that market consistency, that trading consistency, I should say. And the reason why is because all these different trading tools, okay, are only 30% of your trading. Your focus is not at the right place. Understanding how trend lines work, support resistance, Fibonacci, and so on and so forth is very important, yes. But it's only 30% of the work that you have to do. And if you're, a normal, intelligent human being, you should be able to understand those trading tools pretty easily. Maybe after a few months, 1 year, 1 year and a half, you should master those trading tools. So you have the illusion that you know what you're doing in the market if you understand how these different tools work. But you're not seeing the big picture. You're not focusing on what's the most important in your trading, okay? Of course, there's the fundamental aspect as well, but let's keep that on the side for now. It's not very important for this part of the course, okay? So what's important instead? It's the remaining 70%, which is the psychology and the market perception. So psychology, of course, you have your individual psychology, how you manage yourself, how you manage your emotion. We already talked about that at the beginning of the course, okay? But what's even more important is the market psychology, okay? So you have to understand how the market players position themselves in the market, and also what is the market perception. What do I mean by market perception is what's the storyline on the currency or the instrument commodity indices that you're looking at right now. Okay, what's the storyline? What is the price action telling me? How is the market behaving? What kind of information can I get out of the chart that is not related to my usual trading tools? Okay, that is the element that is going to make the biggest transformation and the biggest impact in your, let's say, trading profitability, your advancement as a trader. Always remember that it's player versus player. Usually the larger players are going to be the institutions, like we talked about in the Apex Paragon course. Institutions are the ones who are moving the market, are the ones who decide if a price should go up or down. Those institutions, well, they have behaviors. They have ideas, they have plans, they have agendas. Those agendas, of course, are related to the fundamental, to the technical as well. They use pretty much the same tools as us, but they also have robots, algorithms, stuff like that. But mostly they also have their positioning. So positioning. Because when you are a large financial institutions, you cannot just enter a trade and exit a trade as simply as just clicking a button, opening a trade, closing a trade. Because the positions are so large, you need some planning, you need an accumulation period, you have a distribution period, just like we saw in the AP course, okay? But if you take all these elements together, okay, you get basically the market psychology and you get the storyline of what these guys, okay, want to do, okay? So market perception, what are the other traders doing, timing of the day, price action of the day before, from last week. So basically what you're trying to do here is recreate the story. Recreate the story to understand what's going on and how to position yourself and how to use basically those trading tools and use them correctly in that particular scenario, in that particular storyline. Okay? So you always have to ask yourself, what are the other traders doing? What is the timing of the day? There's certain moves that are going to happen at a certain time of the day. We're going to do a few examples shortly. You have to ask yourself, well, where is the liquidity? Why is the price action acting this way? And you basically have to recreate the storyline, okay? And understand that the trading tools are tools. They are not the ones who are going to make you profitable, okay? They're not the ones that are going to tell you if you should buy or sell. They're not the ones that are going to basically, that you think if you learn more trading tools, if you learn more technical analysis, that you're going to get better and you're going to be able to have more accuracy in your trading. That's not the case, okay? What's going to allow you to be better, to be a better trader, to be more profitable, is your ability to understand the storyline, understand the current market perception, and understand the market psychology, and then using those trading tools in the right way, okay? So let's do an example. This is something I see commonly in the market and is very, very important. And let's say it's a good example to represent this idea. So let's say, for example, I'm looking to do a buy on gold. I don't know why I put it like that. Gold by XAU. And why? Let's say I have 1, 2, 3 fundamental reasons. Okay, so those are fundamental reasons that are telling me that I should buy gold. Okay, so I'm looking at the chart. I'm doing my technical analysis. Let's say we had an uptrend. Market is pulling back. Okay, and I see that right around here, let's say at the 61.8 fib, I have my best possible price. I have a good technical level. So my idea is to basically enter here and join the movement and continue the current market trend, basically enter my buy, right? But what happens when I look at the chart? Let's say I go here to 61, just near it. I don't quite touch it. I just stop a bit before, okay? But I stop far enough so that I can see that the market has not touched this level. Okay, let's say there's a 10, 15 pips, okay, distance between my 61.8, which was also a psychological level. Let's say I had a big support here on the daily or the weekly, whatever the technical, setup was, okay? But here I don't touch my 61.8, and I have 10, 15 pips away from basically distance between my low here and my technical area, okay? Market bounces, goes back up. Now there's two things you might think, okay? Two things you might think. First of all, you might say, okay, well, the market came in the zone, didn't quite touch my level, bounced back. Market bounced a bit earlier, I basically missed the trade, or I'm going to have a late entry in the trade, and you might want to enter a bit later. Okay, so that's your first thought. Second thought might be, okay, we didn't quite touch our technical level, but I will just wait for the trade to come back. Okay, and it's probably going to come back in the next session or next day or next few days. And when it comes back here at the 61, I'm going to buy. Okay, and then I'm going to be able to buy here. So those are the two types of, basically thinking process you can have if you're seeing something like this and you have a good fundamental opportunity to buy. Okay. But me, when I see this type of movement in the market, I try to understand what is the right market perception and what is the correct market psychology. What does it mean? If we moved from here to here, and let's say it's a move of 150 pips or 200 pips, whatever the case may be, we get near the 61.8, we don't quite touch it. And I'm not talking about 2-3 pips difference. That happens, that's normal. That's just market, let's say getting in the zone and not quite touching the line, 2, 3, 5 pips, it's okay, that's normal. But if we're talking about 10, 15, 20 pips, it's a pretty substantial difference. My first reflex when I see something like this, I'm gonna say, okay, the institutions did not want to trigger this area. So this zone, let's say, was not triggered. The large players triggered. So the large players, okay, did not want to trigger this area. Why is that? Well, maybe they're not looking for a buy. Maybe they don't want all those orders and all that volume coming in right now at this price, okay? So automatically when I see this, I understand that something is fishy, something is not right. Because if they really wanted to buy gold right now, and I really wanted to follow my fundamental idea, they would have came to the 61.8, touched this level, maybe leaked a bit, but been in this zone, activated the orders, triggered the buy limits that were here, their own buy limits and other market players' buy limits, and then we would have seen a good reaction and the market would have continued its way. Okay? But the fact that we did not touch it, just means that something is going on and they do not want it to be triggered. Okay? That's basically my first element of my storyline. Okay, you have to understand that the institutions, they are very precise. All their trades, all their basically ideas are well orchestrated. They're very well calculated. Nothing is really left to chance. So if we have a gap like this, it means that something, someone, and institutions did not want this area to be triggered. So what does it mean? It doesn't mean I missed the trade. It doesn't mean I'm going to enter on the trade later. It doesn't mean I'm going to wait for the price to come back to the 61 here and then buy it back. It means something is wrong with my idea. Something has happened, maybe a shift in terms of fundamental, or maybe the fundamental is the same, but we have a hidden agenda, something else going on. Okay? And basically this small price action tells me that if we come back here to this level, there's a very high probability we're going to break it and go way, way, way below. Okay? Because this is the type of behavior, this is the type of market psychology that is telling me that this level does not want to be triggered. If it doesn't want to be triggered, it's because the intention, the market storyline right now is to go below. If we wanted to go higher, we would have touched this area, bounced up, and basically pushed higher. So if we come back to the 61.8, this gives me the information that we are going to break below. Now, it's my job as a trader to understand why is that. If I have a fundamental idea that is bullish, I have to understand why does the market want to go below. Maybe I'm looking at the small picture. Maybe I should be looking at the big picture, and let's say there was a big 38.2 on the weekly or on the daily that is lower and that the institutions want to use to then go a bit higher. Okay? Might be something like that. Maybe something came out recently in terms of fundamentals that I did not update my idea with, and there's a shift. There's something going on. Okay? But just with this type of behavior, just with this little shift, I can understand that if we go back to the 61.8, I can almost just open a sell order here. Okay, I could literally just sell here, put my stop loss above this area from here, and I know we're gonna go lower, look at my technical obstacles, and take profits along the way. Okay? Did I use something specific to do this sell? Okay, I mean, did I use a specific trading tool? Did I use a moving average, a Fibonacci? Yes, we had a break of the support here, the 61.8, but it's not really something that was obvious for everyone, right? The main reason why I did this trade is because I understand what was going on. I understood the storyline. Okay, let's do another example. Let's say, for example, I'm looking for a short this time, a sell. Market is going up, 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 and I have this zone right over here that is important. I'm looking to short. Okay, so let's say market comes to this area. and basically breaks it. Goes like this, okay? So I'm gonna say to myself, well, okay, the area was broken, I'm not gonna do my short. But then maybe the next day or a few hours later on the next session, price comes back down here, okay? And now it's going right up like this. So I might look at this and say, okay, wow, we have broken this level, okay? But just right after, quickly, aggressively, price action came back below this level, okay? We came back all the way down. So I might say, okay, this whole thing might be a SL hunt. So now, if price comes back into my zone, I'm expecting the price to bounce at this area, okay? Have my stop loss somewhere here, and basically have a reaction there, okay? As other traders might see this and say, well, if I've broken this level, this whole zone is not valid currently, but I will argue that this was just a stop hunt. So I understand the storyline. And why was it a stop loss hunt? Because when we came back to the zone, we broke it, and we broke it very fast, very linear. So the characteristics of this price action is we broke the zone, yes, but when we came back, the price came back fast, aggressively, which is pretty much the same thing, okay, and basically in a linear fashion, okay? We came back straight. We did not hesitate, we did not zigzag, we did not consolidate, okay? We went straight from the stop hunt to straight below our zone. When we came back here at this area, if my idea, my fundamental idea is still valid, if I still see that the trade is bearish, then I'm gonna try the trade here, while other traders might try to buy here and say, wow, okay, we broke in higher, so I'm just looking to do some buys here because we're going higher. But currently the right market perception, the right market psychology was there was a stop hunt. We were fishing for liquidity. Institutions were fishing for liquidity, and now we're looking to push below, okay? So those are just a few abstract examples to illustrate my point. I think you get the idea. But now we're gonna do an example, a more concrete example on the market.